All right, good evening, everyone. Welcome to our federal budget presentation. I'm Randal King, for those of you that don't know me. I've been with Marsh Tincknell for nearly 17 years, working in our tax and business services section, also providing structuring and general tax advice to our valued clients. I'll be partnering today with Sahil from MT Wealth, our financial planning division. I'm going to talk about the tax and business issues, and Sahil is going to talk about the superannuation and financial planning issues. This is the second time that we've made this presentation. A number of our staff have already witnessed this presentation, so if you have any questions, please feel free to contact your valued advisor at Marsh Tincknell. And I'm sure we'll be able to help you out, or if I'm quite happy for you to also contact me. My details there are on the slide. We will provide copies of the slides to all attendees, and also we're videoing the presentation, and we're going to put that up on our website. There will be time for questions at the end. So if you've got any questions as you go, just put that in the Q&A box. If you're unfamiliar with Zoom, we have a chat box down the bottom where you can just make some, if you have anything you want to immediately deal with, if you can just use that chat box. And if you've got a question, just use the Q&A box, which is just a couple of steps to the left of the chat box. Just write your questions in there, type your questions in there, and we will attend to them at the end. So what we're going to cover today, I will just do a brief general summary of the budget for you. Then I'm going to have a look at some personal income tax changes. Also have a look at some changes for business taxpayers. And then I will pass over to Sahil, who will look at superannuation and financial planning issues. And then we'll have some question time at the end. So just a bit of a general summary. The focus of this budget really is economic growth on the back of the COVID-19 driven recession in 2020, and also partly into 2021, I guess. There's no new taxes, but there's lots and lots of spending, including on infrastructure, health and aged care, job creation, business innovation, women's economic incentives, prevention of violence, and a number of other areas. So yeah, it's all about spending really, but there are some tax issues that we will talk about. Just be aware that most changes will generally apply from the start of the first tax year after royal assent. So this is all proposals and announcements. There needs to be legislation passed through Parliament, as we're only about 6 weeks away from the end of the financial year. Most of this legislation is not likely to be passed through Parliament until the 2021-22 financial year. So it's likely that most of these changes will apply from the 1st of July 2022. There are some that do actually have specified start dates, but I will highlight those as we go. So the first change I want to talk about is the low and middle income tax offset, or LMITO. This has been in place for a couple of years already. It was proposed to finish at the end of 2021, so at the end of this year. It's been extended for another year. So it's essentially a rebate, a non-refundable offset that for most taxpayers will result in less tax to pay once you take off the offset, or alternatively an increase in your refund. If you're not paying any tax, there won't be any refund of this offset. It's just purely an offset to reduce tax payable. and it will be received on the lodgement of your 2022 tax return. So it's not actually anything that taxpayers need to do, it just gets adjusted on lodgement of your return. So this is what it looks like. If you're earning 37,000 or less, the maximum offset is $255. Then it shades in from 37,000 to 48,000. If you're between 48,000 and 90,000 in taxable income, the maximum, you'll receive a maximum rebate, which is 1,080. If your income is between 90,000 and 126,000, there's a shading down from 1,080 to nil. Where you earn more than 126,000, you won't get any of this rebate. So it's designed for predominantly for people between $48,000 and $90,000 in income, but it shades up and down, sort of depending on where you sit as far as your taxable income is concerned. Also announced increases in the Medicare low income thresholds for 2021. This happens every year. Essentially what happens is the government increased the thresholds where you don't pay any Medicare levy, just to keep up with inflation. So this, as you see on the screen, these are the increases, depending on whether you're a single or a family or a pensioner, etc. So yeah, you can have a look at those at your leisure. If your income is above these thresholds, then you'll just pay Medicare levy at the normal rate of 2%. Also been some changes announced around tax residency rules. Currently there's some quite complex rules, some quite subjective tests around domicile, place of abode. There's also a resides test. They're quite complex and uncertain, and they revolve around where your family members are living, where your financial assets are based, where you're on the electoral roll, whether you're on that roll in Australia, and a number of other different things they look at. But what's proposed now is what they call a primary test. If you're physically present in Australia for at least 183 days, so 6 months, in any tax year, then you will deem to be an Australian tax resident. There's also a secondary test. Not a lot of detail around this. It hasn't really been finalised as to what it's going to look like, but it's going to be a combination of physical presence and other objective criteria. So just have to wait and see what that looks like. But I guess, yeah, just a more certain test around the number of days you're actually physically present in Australia. There's some changes to self-education expenses. So this has been around for quite a while, this amount that's not actually allowed as a deduction. So if you're doing a course that's going to help you out with your income in your current job, then if you're doing a course at a prescribed educational institution, like a university, for instance, the first $250 of that course is not deductible. So it's only the balance that you can claim a deduction for. As I said, this has been around for 20 or 30 years, I think, but they've now decided that there's no real reason for having that $250 as non-deductible, and they're going to remove that exclusion. Next area I want to talk about is employee share schemes. Employee share schemes essentially provide an opportunity for employers to offer employees a stake in the growth of the company by issuing shares and or options or rights, issuing those to employees at a discount. Subject to various thresholds and exemptions, the employee will generally be assessable on the discount provided. So currently, the laws are, if you cease employment with your employer, that is a trigger point, and you will get taxed at that point on the discount. So that the amount that you've received those shares for versus what you've paid versus what they're actually worth at market value. So there are some other taxing points, such as when the shares are actually vested in the name of the employee, and they're actually able to sell those shares. They can't be forfeited. What they're doing is they're taking out the taxing point where an employee leaves employment. I guess it has been unfair that if you actually leave employment, you've received shares under an employee share scheme. If you're still not able to dispose of those shares, you could potentially be in a situation where you've got to pay tax on the value of those shares, but not actually be able to sell them, and so you can pay your tax on that amount. So yeah, so that's what they're doing. They're removing that trigger point of leaving employment. There's also some announcements around streamlining of the regulatory requirements. So the goal of these schemes is to engage and retain talent, and so that they can compete, so that businesses can compete globally from Australia. So by making the regulations and documentation a little bit easier to do, they're hoping that they'll have more businesses set up these employee share schemes. Just a few other announcements. I don't intend to provide any detail around these. There are additional details and media releases that are available from the budget website. If you have any questions on any of those, any of these announcements, or would like some more detail, just let me know, and we'll get further details to you on those. So first thing I've got there is the increase in the childcare subsidy. This was announced actually before the budget, but just sort of confirmed in the budget. So where you've got multiple children under 5, there is going to be a substantial increase in the childcare subsidy available. There's also some expanded programs that have been announced that will assist people to borrow funds at a much lower deposit requirement from the bank. So they're referred to as low deposit loans. Some of them are at 2% deposit required, and some of them are at 5% deposit required. So it's just a scheme to help first home buyers get into the market without having to save up too much money as far as the deposit's concerned. So that's there, has been announced. There's also some changes to the First Home Saver superannuation scheme. I'm not going to talk about that because Sahil's going to talk about that, and I don't want to steal his thunder. Also, there's the Job Trainer Fund. They've announced that they're going to extend that to the 31st of December 2022. Now, for business taxpayers, a couple of key items for business taxpayers. Excuse me. The first one is around the temporary full expensing of depreciable assets. This was originally first announced in the budget last year on the 6th of October, which is why it applies from the 7th of October. Assets that were acquired after the 6th of October 2020 and first used after that date will be eligible for an immediate write-off. Back in March, I think it was, of 2020, there was an announcement increasing the threshold from 30,000 to 150,000. Then in the budget last October, they actually reduced the threshold, completely got rid of the threshold, so that absolutely everything that you buy, you can write off 100%. So the announcement on the budget was that it's going to be extended for another 12 months. So instead of it ending on the 30th of June 2022, it's now going to end on the 30th of June 2023. Just a few exclusions. Where you make property improvements, for instance, if you made an office extension, that's a capital improvement. Those items are ordinarily deductible at 2.5% per annum. So they're deductible over 40 years. So if you make an improvement like that, you're not going to be able to write off 100%. It only refers to plant and equipment, machinery, etc. Another thing which you need to be aware of, I know when these increases in the thresholds were first announced, the first thing that people did was go out and buy cars and get a 100% deduction for it. What perhaps hasn't necessarily been put out there in the market is that you can only claim a deduction up to the luxury car depreciation limit. That limit is currently 59,136. That's a GST exclusive amount. If you're buying a car that exceeds that cost, you won't get a full deduction. You only get a deduction up to that 59,136. So, for instance, if you go out and buy a Mercedes or an expensive passenger vehicle, you don't get to claim the whole amount. You only get to claim that amount of around about $59,000. So just be aware of that. That is a important exclusion to remember.
Sorry, Randall, while we're on the topic, there was a question from the crowd asking what the situation is if you're looking to claim the purchase of a second-hand asset, and just what rules you need to be and whether that's still applicable if your turnover is less than the 50 million.
Okay, yep, I was going to talk about that and we'll get onto that now. So it does include second-hand assets, yes. So if your turnover is less than 50 million, it doesn't have to be a new asset, it can be a second-hand asset. So most small and medium businesses will be able to claim second-hand assets. Also, something that should be noted, for small businesses, so that's businesses with less than $10 million of turnover, if you are making use of the accelerated depreciation already, so it's referred to as a pool, so all the assets that you have that you're depreciating, you just throw in one pool and you depreciate them at one rate, typically 30%. If you have assets in these pools, then that pool balance will have to be written off at the end of each year. That's going to be the case in your 2021 tax return. So if you're a small business, you aren't going to have a pool balance left after the end of this tax year. So nothing will be carried forward. And whatever you buy during this year, 2022 and also 2023, you will get 100% deduction for that. So everything will be written off in full. You don't actually have an option. You can't opt out as a small business. You have to write off all the assets. That won't necessarily give you the result you're looking for, depending on your circumstances, but that's the requirement. There has been a fair bit of lobbying from the professional bodies on the government to allow small businesses to pick and choose which assets they write off. However, that's not going to happen. That's only available if you're a larger business with turnover exceeding 10 million. If you're in that space, then you can pick and choose which asset you write off. But if you're a small business, then you can't. You have to write it off entirely in that year. Leading on from that, the second extension that has been announced is about the carryback, the loss carryback concession. This again was announced in the last budget in October last year. What it does, it allows companies incurring losses in the 2020 or later years to apply those losses against a prior year taxable return. So that year, that tax return has to be for 2019 or later. But what it means is if you've made a good profit in 2019, paid a heap of tax, but you end up making losses in 2020 or even any year up to 2023, then you can carry those losses back to any year where you've made a profit and have paid some tax, and actually get a refund of some of the tax that you've paid in the past. So from that point of view, it is a very good concession. The first year that you can claim that carryback of losses will be the 2021 tax return. So when we lodge your 2021 tax returns, there will be an election which you can make and actually claim a refund of tax based on what you paid in 2019 or 2020. Just to be aware, this concession is only available for companies. So if you're operating through a trust or if you're an individual sole trader, whatever, you won't be able to make use of this concession. It's only available for companies. Again, there was a lot of lobbying to the government to make it a wider concession, but that's not happening. It's still going to be only available to companies. Yeah, and also another thing to note, you're limited to what you've got in your franking account. So over the years, as a company pays tax, we prepare what's called a franking account that allows the company to pay dividends out to its shareholders and then give them a credit for the tax that the company has already paid. If you don't have any credits in your franking account, if you've gone about in the 2019 year or a later year and paid out dividends and used up all those franking credits, you won't be able to carry back losses. So it's limited to the balance of your franking account. It's also limited to the tax that you've paid in those years. So yeah, they're just not allowing you to have a double bite if you've already used the franking credits and you can't get them refunded. This is not compulsory. You actually have to elect to be able to carry forward your tax losses. Sorry, to carry back your tax losses. If you don't make that election, then those losses will just carry forward as per the usual rules. The reason why they've brought in this concession and extended it as they have with the full expensing of assets, they're designed to sort of work together. Where you're making use, or in most cases you actually don't have an option, but where you're making use of the full expensing of assets, you're likely to create tax losses, and the government are going to allow you to apply those losses against tax that you've paid in earlier years. So it's designed that these two concessions work together. Now this is something new, medical and biotech patent box tax. So it's a new category of taxpayers, if you like. So only for medical and people in the medical and biotech industry. What it does is where you derive income from a patent, that income will be taxed at a corporate tax rate of 17%. From the information I've seen, it's not obvious that it only applies to companies, but on the basis that they're talking about a corporate tax rate of 17%, it must only apply where you're operating through a company. It only applies to patents that you've applied for after budget night, so 11th of May 2021. If you've already got a patent that you've applied for, you won't be able to utilise this regime. The patent must be developed in Australia, and it only applies to income that has been derived from the use of the patent and not to income that you've derived by manufacturing or branding or other attributes of that patent of the business. So it only relates to income you've earned directly from the patent. So this is a bit of a start and see how it goes sort of system, I guess. there isn't a lot of detail about how it's going to work and what the eligibility requirements are. That's still to be decided and probably won't be available for some time yet. But there is an intention to extend these rules to the clean energy sector. So it's something that the government are looking to open up to a wider range of technology type businesses. Digital economy, another offset, so a refundable offset of 30% for businesses that are spending at least $500,000 on Australian video online games development. So again, not a lot of detail on this. The eligibility criteria is still to be developed, but clearly what they're trying to do is support businesses in Australia that are developing online games. Yeah, not much information, but I suspect it's going to run a little bit like the R&D concessions that are currently available. Also around this area, I guess, there was an announcement that there will be a self-assessment of effective life available for intangible assets. So currently, intangible assets such as patents, registered designs, copyright, and in-house software, there are specific statutory rates that you must use when you're writing off the value of these assets, and statutory periods over which you can actually get the value of the deductions. So they've announced that from the 1st of July 2023, you will actually be able to self-assess the effective life. So that's what you do with most, that's what you're able to do with most other depreciable assets. You work out how long that asset's going to be used in your business, and then you apply the depreciation over that period. So that previously hasn't been available for intangible assets, but it's now going to be an allowable way to work out your depreciation each year. Just a few other measures for business taxpayers. Again, very little detail on these. They're pretty much just announcements. But if you require any further information, we can get that out to you. So just let us know and we'll get some more detail out to you. So these measures supporting emerging aviation technologies, development of artificial intelligence, small business support services, investment in technologies to reduce emissions, tax reliefs for brewers and distillers. So this involves a remission of the excise that they're currently having to pay to the government. And this was announced just recently, so before the budget. Also an announcement that if you've received specific storm and flood grants for major rain events that happened in February and March of this year, in a lot of cases, these grants would have already been provided, but they're going to be made tax exempt. So instead of having to pay tax on these amounts that you're receiving from the government, there will be an exemption available. And just a few other items. There's a temporary relaxation of visa conditions for the tourism and hospitality sectors and also the agricultural sector. So I guess this is really just recognising that there are a lot of foreign residents that ended up getting stuck in Australia. Probably their visa has expired, or at least the conditions make it very difficult for them to work in Australia. So they're actually relaxing some of the conditions and allowing them to work more than 40 hours per fortnight in these sectors. So that's something that a lot of businesses in those sectors have been asking for to some extent. So yeah, that's an interesting concession that's been provided. There's also additional support being provided for tertiary and international education providers, and also the arts sector. So that'll be by way of grants. And again, not much detail on those, but that's an announcement they've made. Final thing that I wanted to talk about is the new avenue to pause ATO debt recovery action. Currently, if you're in dispute with the tax office over a debt, so if the tax office have started a recovery action and they're starting to garnish your bank accounts and wherever they can get their money, so their hands on the money. If you wanted to object to that, you basically had to go through the court system and pay lots in legal fees to lawyers. What they're doing is they're going to allow you to apply to the administrative tribunal rather than have to go through the court system. So potentially you can do that yourself. Costs are much lower, and you don't necessarily have to have lawyers involved. So yeah, that's a good concession there. Just a couple of other announcements too. The apprenticeship scheme, where the government are providing up to 50% wage subsidy. That's to be uncapped and extended out to 12 months. So they've just extended the period over which that's available for apprentices and trainees. They're also proposing to provide funding for digital skills training programs. So just a lot more money being put towards those businesses. So that's all I had to talk about from the budget around the tax and business issues. So I'm now going to hand over to Sahil, who's going to talk to you about superannuation and financial planning. Thank you.
Thank you very much, Randal. So the 2021 federal budget contained a number of proposals that will impact from a personal financial planning point of view. So in the next 10 minutes or so, I'll briefly highlight the key changes in relation to superannuation and self-managed super funds, the first home super saver scheme that Randal mentioned earlier on, pension loan schemes, and aged care. So we'll lead on firstly to the superannuation thresholds. These are changes at the moment that are proposed. So the first one is the transfer balance cap. So that's the amount of money that you can move into a tax-free environment such as a pension. And the cap will be increasing from 1.6 mil to $1.7 million, which will be indexed. Moving on, we've got the concessional contribution cap. So that's how much money you can put into your superannuation account each year and claim a tax deduction for. So this will be increasing from 25,000 to 27,500. The non-concessional contribution cap. So essentially a non-concessional contribution is after tax money that you can put towards your super. You don't necessarily get a tax deduction for it by putting it in. However, it goes into a tax effective environment such as your superannuation, which you can benefit from when you retire. And it'll be increasing to 110 or 330 over a 3-year period. Currently it stands at 100 and 300 respectively. Another thing to mention is the superannuation guarantee moving forward will be at 10%. Currently it sits at 9.5. Another thing is the maximum super contribution base is used to determine the maximum limit of any individual employee earning base for each quarter of the financial year. So that you can see is now 58,920. And the government co-contribution is a contribution that the government helps to put towards your superannuation. If you put a non-concessional contribution, if you put up to $1,000, you'll get 50 cents of the dollar. So you can see $500 on the screen. They've increased the lower and upper thresholds respectively, as you can see. We'll move on from superannuation thresholds to the downsizer contribution. So the government is proposing to lower the age Australians can make tax-free contributions to their superannuation from the proceeds of selling their family home, from 65 down to 60. So basically, if you've owned your home for more than 10 years, you and your partner should be able to put $300,000 each into your super. It's a really great strategy and opportunity to increase your superannuation balance in the lead up to retirement. The next proposal is the removal of the work test. So currently, people aged 67 to 74 years can only make voluntary contributions to the super if they've worked at least 40 hours over 30 consecutive days in a financial year. So what they're proposing is people aged 67 to 74 will now be able to make non-concessional or salary sacrifice superannuation contributions without meeting this test. It's a good way to help, again, build up your superannuation in the latter years and also leading up to retirement. However, if you look into this, there is one gap here. So to get a tax deduction after the age of 67, if any of you are self-employed or work for a small company that does not provide salary sacrifice, you may be missing out on this. So it might be worthwhile speaking to the bookkeepers here at MT to see if you're eligible and how that can be structured. The superannuation guarantee threshold. So the minimum income threshold of $450 per month will be removed. This is really good. It just provides eligibility for all employees, regardless of income, to be able to earn superannuation contributions. The changes obviously here helps extend superannuation guarantee to more employees, and also women who are entering back into the workforce at a lower wage. It essentially helps to have that opportunity there to access super as well. This is for self-managed super fund legacy retirement products. So great opportunity. The government will provide a temporarily 2-year opportunity for people to transition from certain legacy retirement products to newer, more flexible products if they choose. So retirees will be essentially able to transfer their capital back into their super account and then start a new retirement product, take a lump sum benefit, or retain the funds in that account. So for some SMSFs, the cost of running these pensions has been more than the actual pension payments they receive. So yeah, really good way to review some older legacy products that you may have invested into and having difficulty getting out of. So one thing to note, as the products are deemed and assessed differently, and sometimes favorably, it's good to seek advice prior to making the switch to calculate how this will actually impact your current situation. Nevertheless, it's a really good opportunity, as up until now, individuals have been locked into certain products that restrict access to capital or the flexibility of drawdown. So really good opportunity to review some of those legacy products. If that's a category that you fall into, you're more than welcome to call Marsh Tincknell and we can see if we can assist you with that. SMSF residency requirements. So self-managed super funds and some small APRA funds finally get a break. You know, the residency rules for SMSF will be relaxed so that members can be non-residents for up to 5 years before this will affect the SMSF. Another thing is abolishing the active member test simplifies the rules and ensures that members and trustees who are temporarily overseas can still continue to make contributions to their SMSF without jeopardizing the fund's complying status. So this will probably be one very good once border restrictions open and international travel starts again. We'll have up to 5 years and still be able to make contributions. The first home saver scheme, so this is something that Randal mentioned earlier. Essentially, this is a good way for first home buyers to be able to save towards their superannuation. So the cap on withdrawals will increase from $30,000 to $50,000. Again, it's aimed at boosting the deposit savings of first home buyers by allowing them to use a tax-effective environment such as their superannuation. It allows the buyer to withdraw the voluntary contributions plus any notional earnings towards their first home purchase. To note that the amount released from super cannot include more than $15,000 in voluntary contributions for any one financial year, and they can withdraw up to $50,000 across all years. So this is great news. As the price of property increases, this can provide a larger upfront deposit for couples up to a maximum of 100 grand combined, or an individual with $50,000. So yeah, great proposal. So now that we move away from super, we'll talk about social securities, and in particular the pension loan scheme. So here the government is increasing the flexibility and attractiveness of the pension loan scheme, and in particular by introducing a no negative equity guarantee. So borrowers will never owe more than the value of the equity in their property the loan is secured against. It also provides access to 2 lump sum advances in any 12 months, up to 50% of the maximum annual rate of the age pension. So based on current age pension rates, a single person could essentially receive lump sum payments up to $12,385 per year, and couples about $18,670. Moving on from that, we'll talk a little bit about aged care. So as you can see on the slide, there's a few dot points on the different initiatives that they're looking to invest into. But overall, the government will deliver about $17.7 billion to aged care over the next 5 years, with a focus on home care as well as the sustainability, quality and safety of resident care. 2 immediate impacts will be the release of 80,000 new home care packages over 2 years from 2021 to 2022, and improved daily living conditions in resident care by contributing $10 per day for each resident on top of the basic daily fee. They're making it more affordable whilst they look at delivering a better service. So those are pretty much the main key points that relate from a tax perspective in relation to financial planning, dealing from superannuation, aged care and pension loan schemes. So from the super, you can see on the board, we've got the main dot points of removing the work test, expanding eligibility to utilise the non-concessional bring forward rule, reducing the eligibility of the downsizer so they can start contributing from age 60, commuting certain legacy products held within a self-managed super fund, the first home saver scheme, so an increase of $20,000, and the SMSF residency rule, so that's being relaxed a little bit. And then from a social security and aged care point of view, there'll be some changes to the pension loan scheme, additional support to older Australians through home care and resources. So what we'll move on to next is some question and answers. So what I'd like to do is invite Randal back on stage with me. And yeah, if you have any questions, we'll be more than welcome to answer them. And if not, we will definitely be sending the material out to yourself today as well. So we'll see with Adrian, give it a minute.
So it appears that we don't currently have any questions to answer, but we'll certainly just allow you a few minutes just to just send us some questions if you have any questions you want answered. If not, happy to answer any questions by email if you think of a question sort of after the presentation has finished. But yeah, if you've got any burning questions right now, happy to take those on and answer them as best we can. Yeah, as I said before, we will send copies of the slides out to all the attendees, and we are going to make the video of this presentation available. Yeah, I acknowledge that there's not a lot of detail to the announcements, and a lot of the detail is going to come out over time as the legislation is drafted and passed through Parliament. So, yeah, certainly not a lot of detail out there at the moment, and a lot of the focus was on spending programs as opposed to changes to taxes and business issues, I guess. So it doesn't look like we've got any questions. So I think we might wrap it up at that point. Oh, sorry, we do have a question. Okay, someone's asked, what do you believe will have the biggest impact? Certainly from a taxation point of view, I think the extension of the immediate write-off of assets is probably going to have the biggest impact. And I guess certainly for companies working in with the loss carryback, they're sort of going to work together. Yeah, but I guess people just need to be aware that spending on assets may not be the best result, may not give you the best result, and it's worthwhile just having a chat with your advisor before you commit to large capital expenditure on equipment, just to see whether that's the way to go. What do you think is the biggest impact from a superannuation and tax planning point of view, Sahil?
I feel the biggest impact from the superannuation side of things is really helping, that age bracket between 60 to 70. There was a lot of restrictions to be able to access money into superannuation. And sometimes, individuals do decide to hang up their boots, so to speak, at that 60 mark, and later on try to access or put money into superannuation. And there can be a few hurdles and obstacles and challenges to face. But the removal of the work test from the ages of 67 to 74 is really providing, a positive avenue to be able to build up superannuation given that stage of life, because you have to, look at it, and it all depends on personal situations, but by far it is the most tax effective environment where you can invest your funds to be able to be a self-funded retiree or supplement your income. So from a superannuation point of view, that combined with the downsize of contribution, where it's more at a realistic age of when we're deciding to do all that, sort of seamlessly, drives people towards, or from the initiatives to really build up super, take a little bit of pressure away from social securities, and really just empower people to build and be self-funded.
Okay. All right, so we don't have any further questions. Feel free to contact us after this presentation. Thank you for your attendance. I know it's a bit of a dry subject, but it is worthwhile, I think, to sort of get your head around what's happening in the budget and how it affects you. By all means, give us any feedback you have, and we'll be happy to sort of help you out with any questions you have going forward. All right, thank you all, and we'll sign off on that basis.
Thank you very much.
Thank you.